Ladies and gents, welcome to Chat with Traders podcast. This episode, it's a little experimental. It takes on a slightly different format to normal. I'll explain. This episode is essentially a response to an email which I received from a listener a little while ago. I read the email out in full during this episode, but just to summarize right now, this gentleman is 38 years old with a full-time job in banking. His wife is currently studying and he has 3 kids. He also has the goal to transition out of his current career into full-time trading. But as I just mentioned, he has a family who are dependent on his income. And that's the part he has questions about. So I asked my buddy Alex, aka @TaggerTrades on Twitter, if he'd be willing to join me for this episode and share his thoughts. Alex is a full-time day trader who has developed skill for trading long-side momentum in US equities. He's also appeared previously on episodes 119 and episode 157. And it would be well worth your time to go back and listen to those if you haven't already. Now, just a couple of things to preface this episode. Given the subject, this episode is targeted towards entry-level traders. The more advanced traders out there, you're probably not going to get much useful from this one. And, while listening back to this episode, I actually thought of a bunch of other things we probably could have mentioned, but I guess the main points we do address were those specifically asked about in the email. You can also find a key point summary of what we discussed in the show notes at chatwithtraders.com/176. And if you'd be interested to hear more episodes like this one, with a similar format answering listener questions, I'd like to hear your thoughts. Maybe hit me up on Twitter at chatwithtraders. Finally, the content of this episode is not to be treated as advice. These are general thoughts only, and you are responsible for your own decisions. Here we go, folks. Please welcome, once again, Alex. How you been, man? We haven't spoken in a little while.
I know. I've been in the weeds with a couple kiddos now, so I've been kind of radio silence trying to manage everything, but been pretty good.
Yeah, it seems like each time we talk, you have another kid.
I know, no more. I'm like about to go in for the old snip, like a pound dog. But after 2, I'm like, this is hard enough, but it's fun. I'm not talking bad about him, but yeah, no more kids for my collection. We're done.
Okay. How old is the youngest one?
The youngest is 3 months old.
Oh, okay. 3 months.
3 months and then a year and a half. So we got 2 under 2, which is basically everyone thinks we're fucking crazy, which we kind of are, but
yeah,
whatever. We're done.
I remember last time we spoke, I don't know when that was, when we did the last podcast. But
I feel like it's been almost like every 12 months, give or take, pretty close.
Something like that, yeah.
Yeah.
You were telling me you were having a bit of sleep deprivation.
Oh, yeah, big time. Our youngest just started sleeping through the night like last week. And I keep waking up every morning and being like, oh, I'm going to get caught up in sleep. And it hasn't quite happened yet, but we're close. I'm going on vacation tomorrow night for 5 days, and without the kids, without the wife. It's a bachelor party. So I'm like, I'm going to sleep so damn much, but let's be honest, I'm probably not.
Full on, man. Where are you going?
Yeah. We're going to Colorado in the mountains, and we're going to do some fly fishing and some brewery stuff. And it's much better than the typical Vegas, at least United States, Vegas bachelor party. It won't be like that, but
that'll be really cool, man. Yeah,
I'm looking forward to it. Nice little unwind. I've been going hardcore for a while, so I'm ready for a little break.
Yeah. Oh, that'll be fun.
Yeah.
So how's trading been this year? I mean, what are we, like, dude, 5 months in now?
What's up? Yeah, we're about close to almost done with May. I've been on a heater since like last October. Coming into May, just pretty consistent, pretty awesome. I mean, I don't really like when I talk about it on the podcast, money-wise specifically, because I'm trying to kind of stay away from that. But I took my biggest intraday or biggest daily loss ever today at $8,200. So market's kind of telling me to, and I took a pretty I had an intraday drawdown of about $16,000 last week. And it was an illiquid stock that I got too big in, and I ended up wiggling my way out for like a $2,500 loss. Should have taken the sign, but I kept pressing, and I fudged up today. But looking forward to the vacation. I think I just need a little break.
Wow. Okay. So you probably didn't really want to talk to me today.
No, I mean, no. You know what? I knew it was coming. Let's be honest. Like, it happens, right? It's part of trading. So. I've been going hot trying to press size, and then I didn't see the signs to back off, and I kept pressing, and clearly it's just signs that say I need to back off, and I'm still up on the month, so whatever. But yeah, I mean, I knew it was coming.
Well, that's nice to hear you've had a good start this year.
Yeah.
Why do you think you had that biggest loss today? Do you think it's purely just a factor that you've been trading a bit bigger lately, or
yeah, 100%. I looked at it over again. I looked at it 4, 5, 10 times a day. It was valid. I just took way too much size, and the market's not risk on right now. So I need to be able to get better at identifying, like, okay, I'm allowed to size up. Like I've earned it, but it's just not the time to size up. And that's kind of where I screwed up. I put on a lot of size. The liquidity wasn't there. Tried to start selling some, and then it just started. Every time I was selling, it was like, they knew they had me or somebody on the other end. So they just kept pulling it, and I couldn't get out. So the trade was valid. I just couldn't get out where I wanted to. So if it was like 2 months ago when I took that much size, I probably would have been a huge win. I've had plenty of wins that are much bigger than that, but it just, yeah.
Yeah. Okay.
So.
Oh, expansion, eh?
Yeah.
It's just what happens,
Yeah. I mean, it's a part of the game, right? I avoided it for a long. I only had 2 losing days coming into this month, and like the biggest loser was like $150 in a day. And I'd been running really hot, not taking losses, and being able to wiggle out of everything, and couldn't wiggle out of it. And I wiggled out last week, right? So I think that also, perfect storm, wiggled out, thought I could wiggle out today, and I couldn't. So just telling me all right, let's go back into cut size, grind back, and then we'll push when it's time to push.
Right. And what have you been trading lately? Like, what's been hot?
Small caps. That's what came into the year really hot. Into last year, obviously, we shit the bed in the markets, but the bounce back, there's a lot of risk on. It's been pretty good, but right now I think we're kind of in I bet we're probably going to chop through this whole summer and just kind of not do much. So
I remember last time we did the podcast, it was just coming off the back of the sort of the crypto bubble.
Yeah.
And I remember you'd been talking about trading a lot of the crypto sort of related stocks. How have they been going lately?
They follow directly with crypto. So they hadn't been doing shit till probably, I don't know, what was it, like a month ago when we started perking off 3,000 on Bitcoin. And I got some pretty good trades off of them, but I just think that, everyone's so butthurt probably from losing a while back that no one's being really aggressive with crypto right now. At least from what I can tell. I'm sure if you're actually trading the coin, there's a lot of volatility and stuff, but when that presents itself, it's a green light go. It just hasn't had a lot of the momentum that followed through into the actual stocks this year.
Gotcha. Okay. Cool, man. Well, let's get into it. So, the format of this podcast, I guess, is going to be a little bit different because right. I guess it's not so much about you or myself. It's really about, well, let me just get right to it. I received an email a couple months ago, recently, and it just kind of stood out to me. And I thought, this is a really good email. It's really nicely written. It's very genuine, and I feel as though it's quite relatable to a lot of people who probably listen to this podcast. And this person was asking a question, and instead of just giving an email response, which I'm often pressed for time, so my responses are normally quite rushed, I felt as those deserved a little more attention. And I thought that you'd be a great person to answer this question because it's very fitting. So let me just read through this email. It'll take me about a minute or two. And then I reckon we break it down a bit and kind of flesh out the different parts to it and, go from there. So the email says, "Hi, Aaron. Hope this email finds you well. I'm sure you are no stranger to constant messages of thanks for all your terrific content, but I wanted to chime in as your podcast has truly been a turning point in my life. At 38, a father to 3 young children and stuck in a career in banking, your step-by-step interviews with industry leaders has inspired me to actively pursue my passion for trading. More importantly, though, your interviews have provided me with key directions and access to great minds and advice that I otherwise wouldn't be able to access. So thank you. In a bid to actually move out of my current and long-term banking role, could you point me in the right direction? I would absolutely love to make the transition this year. However, we have a young family and my wife is still completing her degree and training. As such, my salary is our lifeline. In between studying for a Master's of Applied Finance, I'm on the podcast Spark trial platform, reading Bella's One Good Trade and the playbook and your own ebook, Grow or Die. But I'd be forever grateful if you could recommend some actual steps that I could take to get the knowledge behind me and start doing the trades. I also reached out to others that you have showcased and who fill my Twitter feeds. I was seeking mentorship and hoping to learn through an apprenticeship, but no luck, and even told that this was a myth, sadly. In your opinion, do you think that with little startup capital, moving from my current position in commercial lending to a prop firm to learn as a graduate would be a useful move? And in doing so, are you in the know to recommend any at all? Thank you for taking the time to read this, Aaron. I know how insanely busy you must get, and I really appreciate any advice you can throw my way. Look forward to meeting you in the flesh at a trade catch-up one day also. And we'll leave the gentleman's name anonymous. So there it is. That's the email. Like I mentioned, I think you'd be a great person to speak to this, Alex. So I've kind of looked over this email last night before we got on this call and sort of broken it down into a few different parts. I think that's probably the right way to go about it. So what this person is kind of looking for is some ultimately, how can they get out of their full-time job and go and transition into full-time trading? It does sound as though this person doesn't really have a lot of trading experience, like they're quite new to it all. I sort of get the impression they maybe haven't taken too many actual trades, but certainly very interested in it and would like to leave a banking career for a full-time trading career. So they asked for some actual steps, and I quote here, actual steps to get the knowledge behind me to start doing the trades. What that kind of says to me is, what steps can they take to become profitable? So let's just start right there. What are your thoughts on that, Alex?
The way it's going to work and the steps are going to be different for really everyone, depending on so many different factors. So there's a lot to look into it. But just as the simple of going from not taking a lot of trades to becoming potentially profitable, it really comes down to trading, right? I mean, it's as simple kind of as that. You're going to have to, it's a trial and error, and you've got to learn a lot. As far as, are there specific steps you can take to becoming a profitable trader? I think a lot of it's in the front end of building a really good foundation. If you're going to be, I know he said he was using Spark. I don't know if they have a demo platform, and there's a lot of debate between going demo to live trading. But it really for demo, I would think that you kind of it's how you would learn your platform. But as far as actually starting trading, start trading really small, and then build processes to protect yourself. So kind of setting loss limits, things like that. But what I think would be best for this person that's sending an email is to start taking trades and tracking the results and seeing, does he have anything? Does what he's thinking about, maybe what kind of stocks he's or options or futures or planning on trade and see if there's any kind of click there. Is there any kind of flow? And really try to find something that suits you. But as simplifying into steps. It's so broad, and everything you trade is going to be so specific. But yeah, I'm not sure how to answer that one exactly.
Yeah. Well, this is one of the things I was going to say to you is I know people like to think about things in steps.
Right.
And it kind of makes for good articles online and that type of thing. It's a nice heading that makes people want to click. But in some ways, I kind of wonder if trading can actually be simplified enough to be broken down into steps. Like, is there such a thing as a step-by-step process for how to become a profitable trader? Because, one of the things you just said there, a lot of it is trial and error, especially up front. One of the things, I guess, it kind of sounds as though this person might be asking about is what type of things should they be trying to learn about? Like, what should they be trying to work on?
Yeah, I mean, right off the bat, I think everyone thinks of how much they make, right? That's pretty much why anybody gets into trading is, they see profits or other people making a lot and they think, how can I make a lot? But really, whenever we're starting, it's get in there, take a lot of trades and just really manage risk, know exactly what you're willing to risk on all of your beginning trades, trade like as small as you possibly can, 1 share, 10 shares, whatever, just to get the feel going, get those emotions kind of practiced and be in the market and see how it feels and how it moves and how it reacts. But what I would say is, off the bat, really try to set up a foundation or to avoid the big blowups. And with time, and once you take enough trades, pretty much anybody you talk to knows that you see all the trades and you can see what's going wrong and you can see what's going right. And it at least gives you somewhere to start, because I think most people who start trading, including myself, when I jumped in full time, I didn't know much, but you have to throw yourself in there and learn. It's really, you can read a book. You can, like you said, you can see a site that has, step-by-step checklists, but it really depends on your personality. There's so many different aspects that it's not as clean cut as that. And, there are really good books out there that I, have a couple on my blog, and I know we spoke last time and you asked what I read and my mind went blank, but, in my opinion, the further you look back, something like Trade Your Way to Financial Freedom, I think it was by Tharp. It does kind of have a step-by-step of what you should do, but it's kind of geared towards swing trading, and it doesn't really go into a lot of day trading, but it doesn't matter. All the foundation's the same.
Well, what do you think about someone who's in this particular situation? Like he says, he's about 38, has a wife, 3 kids. I don't know if he says he has a mortgage, but he obviously has responsibilities, and pretty much his salary is supporting the whole family at this point in time.
Yeah. So there wasn't enough information to make like you can make the jump. You have it all lined up right there.
But do you think someone in this situation is probably best to begin trying to swing trade? Because because he says he's been experimenting with Spark. So Spark is a platform for viewing Australian equities.
Okay.
Which I know you already know that. I'm just pointing that out for the listeners. I take it that he's focused on Australian equities, which probably means he's living in Australia and he has a day job. So that makes it difficult to day trade. Do you think someone like this should maybe spend their time and effort on more of a swing trading approach?
Definitely. While they're working full time, I would say swing trade. That way you can at least get a feel to start to trade. There's no way you can manage a day trade while you're working a full-time job. It just doesn't work properly. You can't scale that. But you can get practice by swing trading. And it's kind of like, the hot thing to talk about right now is like a side hustle, right? Everyone talking about starting up side hustles. Well, this can kind of be a side hustle where you can practice, see if you can at least build some confidence, some momentum before you make the full-on jump. Because I've kind of seen where I made the jump when I was 24 and I didn't have kids and I really didn't have a lot to worry about. But I also know where he is now that I have 2 kids. It's much different just to say, yeah, man, just jump. You'll figure it out. And if you don't, what's the worst that can happen? Well, unfortunately, you have a family, you need to be somewhat responsible for that. So, do you have any savings? Do you have like a safety net built in there? If you were to jump in full time, could you live without an income for 6 months? That would be really important, because that is if you want to make the jump directly from working to full time trading. Now, if you want to work on the side, it frees you up so much to take losses, and it's not going to wreck you because you still have your full time income, and then you can really work from there and kind of and build your base, your foundation, and your knowledge while you're working.
What are your views, because you're someone who's an active day trader, what are your views on swing trading as an approach to trading? Like, obviously there's the pros and the cons if you want to compare it next to day trading. What are your thoughts on that? Like, do you feel as though it's a valid sort of way to learn about how you can make money as a trader?
Oh, 100%. That's how I started trading, was swing trading. When I was working full time, I was swing trading. When I got into trading full time, my plan was to be a swing trader. It did not work out for me, but that doesn't mean it doesn't work. The reason being is I am such a cautious person that holding positions overnight, I would just lose sleep. I would be on the message boards all night and checking things out. But it doesn't have to be that way. It's just the way I personally am. So I made the transition over day trading. But no, swing trading is completely valid. I'm sure people probably do way better at trading via swing trading than I do. But no, it's a good way to start. But at the same time, if I could go back in time, I would have tried to focus on day trading earlier, just because that's where I ended up and that's what worked. But for some people, swing trading will work if you're more of a person who doesn't like to be in the fast pace and in the rush and the news and everything in the short term matters. Then you can widen your time frame out, be a swing trader. Don't worry so much about the small moves each direction. You're looking for a bigger target, and that's your mindset. That's your mind frame.
What do you think? Now, I know you don't do much swing trading nowadays. Are you always flat at the end of each day?
I am, yes.
Okay. So let's just say this person is going to consider swing trading. What do you think might be some good skills for them to try and develop? Like, what sort of things should they be looking for? Now, I'm not saying maybe should is the wrong word, but what are some ideas?
Yeah. So the thing that I've kind of, a light bulb that's gone off at some point in my career was that things that have worked for, hundreds of years will probably continue to work. So certain patterns that have worked. And I know we've talked about them in the past, and kind of what I look for as a long bias trader, things like flags and pennants and certain setups that happen on all different time frames. A flag can happen in a 1 minute, a 5 minute, an hour, daily, a weekly. They happen in all different time frames. So really starting to learn how to spot patterns. That is, if you are going to be a technical trader, which I assume probably most people, or according to what this person's talking about, if he's talking about a prop shop, it's usually technical trading. So learning patterns. And then, really important is as simple as just support and resistance. Where's support? Where's resistance? Once you can just start creating a catalog of seeing how support and resistance works, it's kind of the foundation of trading. It's built, pretty much every strategy is built around that. So learning where support is, that way you can start managing risk. And then once you learn where resistance is, you can start learning how to sell better and better exits. But it's just going to take a lot of repetition, a lot of seeing the patterns over and over and over again and how they play out. That's how I would recommend for somebody who's swing trading or day trading or whatever you want to trade, or however style is really start with the basics and look back to what's worked for a long time. Because we've seen these things play out for, as long as we've had charts.
Yeah. And what would be your suggestions around sort of how many things you try to focus on at a given time? And when I say things, I guess I'm talking more about, if you want to use the term setups, like how many setups should you focus on at any given time as maybe someone who's a swing trader? So as a swing trader, you've got to bear in mind that you're probably going to you're going to be trading less frequently, typically, than an intraday trader.
Yeah. So this is something that I've talked about with other traders that have made it longer term or seen guys that have been consistent or lasted for a long time. Pretty much across the board, everybody recommends finding your one setup in the beginning. people try to create these massive playbooks before they're even consistent. And that's really not helpful at all, because you're just shooting your bullets everywhere. It's hard to track. It's hard to learn when you're just trying so many different things. Pick a pattern, something that has worked over time, that consistently works. A lot of it's about trust. You have to trust these patterns. You have to have been in them. You have to see how they play out. Find one thing that you can get really consistent with, and then use that to build off of. I didn't do that, unfortunately, for the first probably year or two. I was all over the place shooting everything, and that held me back. But once I kind of found my bread and butter, my thing that I could wake up, and every time I thought, okay, at least I had a shot. Was it going to be a winner? Not always, but I had something to build off of. Start with one thing, and as soon as you get good at it, you can either just try to get amazing at it and focus on that one thing, which you see a lot of really good traders do. One pattern that they are just amazing at, inside and out. I mean, heck, you got some guys that only trade one stock or one futures contract, and they know that inside and out. But then the guys that can do it all, that can long, short, options, futures, and do it all. Now, they more than likely started with one thing and started building from there.
Mm-hmm. Yeah, well said, man.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, let me just throw out an idea. If this person is interested in day trading or trading more actively, how about trading the crypto market? Because I've often suggested this to some people who say they'd like to day trade, but they have a day job and it kind of rules that out. I feel as though the crypto market could be a fairly good learning ground for someone because it's easy enough to access. You can start with small amounts of capital, and there's quite a bit of volatility, especially at the moment. And that it trades 24/7. So
right.
You can, maybe, I don't really know what if there are active hours in crypto, if it sort of dies off between certain times or what, but maybe if you have a day job, you can come home at night and for 3 hours between this time and this time, you can trade crypto, or I don't know. What do you think about that idea?
Yeah, I mean, it would be something kind of similar like trading futures, which are 24 hours. They definitely have, and I have never personally traded crypto itself. I've traded the equities that are related to crypto in the U.S. market. But when you look at a crypto chart, you can tell that there are periods where different countries are mainly awake, that there's a lot of volatility. So no, I see what you're saying, because you could go to work, and then come home and then practice day trading on an instrument that maybe has a lot of volatility or liquidity at the time. Yeah, I mean, I've never really thought about that, but no, it sounds like a valid idea. That is, if you want to get, in the thick of it all and really watch, order flow and see how things move on shorter time frames. Yeah, finding something that and I know there's other people that live in other countries that after they get done, I know some Aussie traders that I've seen on Twitter that they trade the U.S. markets whenever they're not working. So, you could also look at something like that where you can trade away from work and treat it like a real job.
Yeah, that's tough. I got mad respect for anyone who's in Australia trading the US market, because those hours are not friendly.
Yeah, or your buddy Nick, who you've had on the podcast before. He lived in the States and traded Aussie markets.
Exactly. Yeah.
So I mean, it's doable. Would I want to do it? Hell no. But if that's what it takes, and you really want it, and you want to get the practice in, then sometimes you got to do what you got to do.
Mm. Now, one part from this email, which I think we should zoom in on, he said something about, let me pull up the email. I would absolutely love to make the transition this year. Well, we're currently in May.
Mm-hmm.
So what's that? There's about 7 months left of this year. What are your thoughts on that? I think it's a little bit naive.
I mean, look, anything's possible. We've seen the outliers out there, so I don't want to say it's not possible, but you're just giving yourself such a low runway that to get it figured out. If you've got one bullet to give it a shot, I would, knowing what it's like to have a family, I would make sure I was more prepared before I made the jump. But it's not to say that he couldn't just bust his ass and get it all figured out, which is possible. But realistically, I don't know what the actual numbers are. I know we've seen them all thrown out that like 90% of traders don't make it for past 3 years or something like that. What can you do to not be in that 90%?
Yeah, I think I don't know. I don't know if you can put like a time frame on it like that. Like, I don't know if you can set a time frame for yourself. Like, I need to transition this year, so I've got 7 months to do this. I think everyone's just different. I know it sounds really cliche, but it's just the way it is. I think it'll happen for you when it happens, almost.
I kind of think of it like a lot of people always ask, when do I size up for people that are trading? When do I size up? How do I size up? And the one thing that I've kind of spoken with other people and I've thought about before, it's not really, it's not like really there's just like a time frame. Like you can't say like 6 months, kind of like he's saying. You have to earn it. You have to, have proven consistency. You have to know what you're doing before you can up your size. And I'm assuming it probably translates to making the jump. You should feel comfortable and confident before you make that move. And if you're not comfortable and confident, I probably would bet that your trading will reflect that.
Yeah. He also pointed out in his email that someone had said to him that it was a myth that he'd be able to do this. I don't know if myth is maybe the wrong word, but meaning that the likelihood of him being able to sort of leave his current situation, or not leave his entire situation, but leave his current job and transition to full-time trading at 38 with kids, who's dependent on his salary, etc. How realistic do you think it is that, this person may be able to do that?
Yeah, I mean, I would say the myth more or less is the fact that the lovely Twitter and all sorts of marketing makes you think that, you can just buy a system and it'll work, or something. There's a simple way to make it work. When the fact is, it's not a simple way, but it's possible. So I don't want to say it's a myth, being able to make it, but it takes a lot of hard work. And like anything, I mean, any business you start, it's not just going to just take off right away. It's anything that you do, any sport you start, anything you start, it's possible. If I start playing golf tomorrow, am I going to be a pro, in a year? Probably not. Could I? Maybe. So yeah, I would say making it is not a myth. It's just very difficult, and obviously the numbers show that.
Mm. And the other thing he pointed out as well through the email was, by the sounds of it, he'd like to find a mentor of some sort. He said even learning through an apprenticeship. Well, an apprenticeship, explicitly, doesn't exist in trading. I guess you sort of learn through different means. But what would you say to someone who's trying to seek out a mentor? I mean, you didn't really have a mentor as such, did you?
No, I didn't, but I wish I did. It probably would have cut the learning curve down a lot. I've spoken with guys who had true mentors. Now, you've got to understand that there's air quotes mentorship and there's mentorship. There's something where you can pay a fee and be mentored with 100 to 200 to 300 other people, but you're not really getting personalized help, which is where it really benefits. But I have heard of specific cases where people have gotten mentored right from the get-go, and it helps phenomenally, either from a friend or family or something. I didn't even know anybody personally who traded before I started, so that really wasn't an option for me. But I mean, I'm sure if you look hard enough in your network, there's maybe somebody out there who's traded, or hell, who's even given it a shot and it didn't work, and they can tell you what doesn't work, maybe. But I mean, it's tricky to find good mentorship, but I imagine if you could find it, it would be extremely valuable. But you needed it to be more of like one-on-one to like maximum 1-on-4, where it's very true mentorship.
Yeah, and I would just like to emphasize the point you made there. I mean, there is a big difference between mentorship when you're paying for a product, I guess it's not a product, a service online, and in comparison to like a true mentorship relationship.
Oh yeah. Every time I see it, I kind of roll my eyes a little bit. Some of the marketing for it, because it's like you can't help that many people really well. And if you're going to try to be a mentor and focus on somebody, that one person. I mean, hell, I don't even have it in me. I don't have enough time in my life to mentor a single person because I've got enough going on with trading, family, friends, and whatnot. So to find somebody who can really dedicate time would be very valuable, but just be very cautious about that, I would say.
I think what's also really valuable is just getting like some buddies who are into trading as well. Like I've mates here who, we catch up, go grab a burger and drink, one night during the week or something like that, like that sort of thing. And, we just talk about trading and whatnot. Like that sort of thing is so helpful. And I think a lot of people get caught up on this idea of having to find a quote unquote mentor, which is very difficult. Not saying it can't be done, but it is difficult because it's really a big ask on your part when you're asking someone to mentor you. Where it's much easier to, connect with a few other people who trade and, just speak to those people on a regular basis, whether that's once a week, once a fortnight, even once a month. I think you'll gain a lot from that. And it'll sort of more of a two-way thing. These people don't have to be gun traders, but just people who are, good thinkers, who are, actively trading, have a passion for it, very interested in it, and are keen to develop and get better. From having sort of a small circle of other traders who are doing that, and they don't even have to trade the same products as you.
Mm-hmm. Oh, I 100% agree with that right there. You don't have to trade the same products. You have to trade because it's a mindset, and it's only people who have actually done it and done it quite a bit understand it. But it like you said, it's so great to have the person who you can reach out to when you take a big loss and you're trying to explain it and you bounce ideas back and forth and you figure out, oh, well, this is what I did wrong. Probably more than I think a mentorship would, because somebody who's way above you is trying to teach you, and they may have some, I don't know. It's probably hard to imagine what somebody who doesn't know what they know. That didn't really make sense, but
I know what you're saying.
Yeah. So I mean, there are people that I do talk to probably weekly, if not more often. But whenever a big trade happens or a big loser happens, that I can message them right away and we'll talk about it and high five or be sad or whatever because my neighbor's not going to get it. or my best friend who's maybe has a few indexes or something like that isn't going to get, the ups and downs and the beat downs and the bad beats, I guess you could say, and things like that. Yeah, I think it's huge. It would be very helpful. And I didn't have that early on because everyone that I was friends with, I would talk to for a few months and then they would disappear, likely blowing up. But it was still good to talk in the beginning, just to know that we're not all crazy, right?
Yeah, exactly. That's half of it. So I think what we just spoke about there, that was quite important. Don't get too caught up on trying to find a mentor right now. I think there's more value, or maybe I shouldn't say more value, but just as much value in trying to get a couple buddies who are into trading as well.
Yeah, definitely. And you guys can grow together. And if you got like 3 or 4 guys who really want it, I mean, that could be a pretty, probably pretty helpful.
Yeah, it's pretty motivating. I mean, you can all kind of feed off each other's energy.
Yep, totally.
And I guess the final part of this email, leading on from the mentorship, let me just read out what he said here. In your opinion, do you think that with little startup capital, moving from my current position in commercial lending to a prop firm to learn as a graduate would be a useful move? And in doing so, are you in the know to recommend any at all? So I'd prefer not to recommend any specific prop firms just on the record, but I don't know. I have a couple thoughts on this. I don't know if you want to maybe start, Alex.
I didn't go that route, but it doesn't mean it's not the good route to go. When I started, I honestly didn't even know what prop shops were. So, golf clap to that guy. He's more aware of that than I was. I think if you can get with a good firm, and not recommending any, I've never actually seen any P&Ls legitimate, so I can't verify. But I think if you can get in with a good firm, now that's kind of maybe where you're talking mentorship there, where you have a group of people that are financially tied together, and them helping you out helps their bottom line, and that's probably somebody who's going to help you, right? But I remember the last conversation, I think you had a podcast a few weeks ago with somebody down in Austin who said even at their firm, the retention rate's like 13%.
Yep.
So it's not like that being in a prop firm is just going to solve all the problems and you should just jump ship and go over there. It's still going to be hard as hell. But yeah, I mean, sitting down with a group of people that are trading actively and getting in the weeds with them, that I could imagine being pretty helpful. And maybe if I could have done that earlier, it would have been nice. But at this point now, I enjoy where I am. I enjoy learning by myself. But if you're more of a group person, I could see that being very helpful.
Yeah. Now, something I would like to point out, and I guess it's a little bit of a side note, but I think it's well worth mentioning because a lot of people are unaware of this. I kind of categorize prop firms as 2 different types of prop firms. Okay, so there's prop firms where you come in and you trade your own account, you trade your own book, the firm's capital, but you are responsible for your own P&L. And most of those firms, they don't pay a salary, and you simply get paid when you make money. You take a split of your P&L. If you lose money, then you're losing the firm's capital and you don't get paid. You've got to get yourself out of that hole into the green, and then when you take you want to withdraw, you take a percentage, you take your split of the P&L that you've earned, and the firm keeps the other part for putting up the capital, the infrastructure, technology, etc. So that's one type of prop firm. And then there's also another type of firm. These firms operate what I would call more in teams. So, for example, I've had a couple members from DRW on the podcast in the past. You've got your Virtues, Susquehanna, those sorts of firms. There's multiple teams within this firm, and they trade. Most of them get paid a salary and a bonus. But most of those firms are also quite tech heavy.
Kind of like black box style trading?
Yeah, maybe not strictly black box, maybe some gray box, but a lot of them sort of are quite dependent on technology. like sort of quant-driven stuff. They do still have traders though. Yeah, I just think it's important that people realize there are two different types of firms out there, because I think some people think when there's a prop firm, that purely means the only option is that you get a split of your P&L and there's no salary. There is also the other option where you're on a salary and then you get a bonus, I don't know when that is, every 6 months or end of the year, based on how your team performed. Now, your team might consist of some developers, some researchers, some traders, a quant, someone who specializes in networking, that sort of thing. Those jobs are typically, I guess, harder to get and require you to have some sort of, depend on what the role is, require you to have a master's degree in something or other, or some higher education in specific things. Whereas I guess traditional prop trading is probably, there's the barrier to entry is a little bit lower. But there's also typically no salary that comes with that. So, a bit of a tangent, but going back to the question, I think that's one thing you have to be very mindful of, is that going by what is said in this email, I feel as though this person is probably more thinking about traditional prop trading. I think they have to be aware that they would likely not have a salary. So having little startup capital, now I don't know what little startup capital means, but typically a prop firm is not going to require you to put up your own money. And I'd be a little bit cautious of any firm which does require you to put up your own money. So I don't really know how that plays into this question. I would more say that little startup capital you should more be talking about having enough savings to support yourself while you're learning and trying to actually become consistent and actually be able to make money as a trader.
Yeah, totally. I mean, you could either use that capital to trade your own book with, and then, hopefully you still have it at the end, or yeah, you could use that as your actual savings, what you live off of while you work for a prop firm and work your way through the likely or initial drawdown until you work your way out.
I think one other thing is that try and do a little bit of research, because the sort of the culture in prop firms, I think, varies quite a lot as well. Some are very focused on development. Some you're almost left to your own devices a little bit. You're given the capital and the buying power, the limits you need, and then it's sort of up to you to work it out. So, yeah, the culture does vary quite a bit from firm to firm. And I think a lot of people are probably scared to do this, but I think it's a very simple thing that you can do, is just pick up the phone and call one of these firms. If you're just considering, if you think it would be beneficial for you to get into a firm and you'd like to explore that option, just pick up the phone and make that call and try and speak to someone. I remember when I was working at the firm, we'd occasionally get calls like that. Most of them I would deal with. And I was, I was always willing to help someone on the phone when they called up and sort of point them in the right direction and, potentially speak with them, bring them in, see if they'd be a good fit or not, and maybe sort of give some suggestions on where to go. So I feel as though it shows initiative and it shows that you're actually making an effort, and it kind of separates you from, I guess, most other people who might just send in an email. Like, there's nothing wrong with sending an email, but some of these firms might get quite a lot of emails and yours might get missed. So at least just pick up the phone, have a conversation with someone, see what sort of people they're looking for, what skills they require, who they're looking for, and try and, if it sounds like you may have some of that, then, try and meet with them. I don't think it should be as daunting as what some people perhaps make it out to be.
Yeah, I mean, for this reader, he's really got two options: go out on his own, or go the prop route. And in his situation, it seems like if he really wants it, and he wants to do it, and he wants to do it in 7 months, that potentially his best bet is to do the research and find a firm he'd be happy with, and try everything he can to get in there.
Yeah.
Yeah. No, I agree totally.
Yeah. Cool, man. Well, I think we've addressed most of the points in that email, and we've gone for about 50 minutes. So I thought this would be like a short 30-minute podcast.
I think we both thought that initially. Yeah.
Yeah. Anyway, let's leave it there, and hopefully there's been some good insights from what we've discussed. Hopefully this has been helpful to this particular listener who sent in the email, and anyone else who might be in that situation. Again, this is not to be treated as advice. It's just general.
Oh yeah. No advice for me.
General thoughts. Yeah. Let's call it that.
Yeah. Perfect.
So obviously you're responsible for your own decisions. So don't forget that. Alex, if someone wants to follow you, you are on Twitter. Do you want to share your Twitter handle?
Yeah, it's Tagger Trades, TAGR Trades. I'm, like I said earlier, got 2 kids right now, so I haven't been very active. But maybe I will again in the future. Who knows?
No pressure, man. No pressure. We got a 3rd podcast out of you, so we're grateful.
Yeah, it's our every year, our annual podcast.
Yeah, put it in the calendar.
Cool.
And I will also mention, if you want to hear more from Alex, check out episodes 117 and 157. Really great episodes. I highly recommend. You'll learn a lot from those. Alex, I appreciate you doing this, man. Thank you for fitting it in. I know you've got a busy schedule, so we do appreciate it.
Well, I hope it helps, and I'll talk to you in a year.
Thanks, man.
All right, see you, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey, what's up? Aaron Fifield here. This is episode 177, and I'd like to introduce to you a special guest of mine, Sam Bankman-Fried. Sam's trading skill originated from 3 years at Jane Street, a proprietary trading firm renowned for being one of the largest ETF liquidity providers in the world, and also renowned for their secrecy. In late 2017, Sam relocated to Hong Kong and began his foray into the cryptocurrency market when he co-founded Alameda Research. Alameda trade a range of quantitative strategies such as statistical arbitrage and market making, which are mostly automated but have a layer of human intervention. In less than 2 years, Alameda has grown to a point where each day it does approximately $1 billion of turnover and accounts for somewhere near 5% of global crypto volume. Sam and I got to discuss many aspects of how Alameda operate and how his team have found lucrative opportunity amongst a chaotic environment. The sound quality on this episode, it isn't perfect, so I do apologize for this. We did the best with what we had, and I'm sure once you get a couple minutes in, your ears will quickly adapt. Anyway, now on with the show. Let's get it going. Here is Sam for episode 177. I got to say, I really enjoyed that video you posted the other day. I think James, who was probably there somewhere close by, filmed that. That was really cool. That was nice. That was cool that you guys sort of shared that. I feel as though you don't really get insight like that very often. You know, like most trading professional market makers or like trading desks don't normally share that sort of stuff.
Yeah, it's pretty rare. I think that a lot of it's because of, IP sensitivity. People don't want sort of their trading secrets leaking out. And so, it's just generally a pretty secretive culture.
Yeah. And I mean, you didn't necessarily give away anything secretive. Like there wasn't really much to hide there, but it was just cool to kind of see you trading around a sort of a pretty interesting event like that.
Thanks. It was an exciting time. I mean, I think it's definitely the most exciting parts of the job are when trading gets busy. So
yeah, because there's certainly a lot of times where it's boring. Well, maybe not quite so many times in crypto.
Yep.
Yeah. So anyway, that was good. Now you as a trader, your training ground was at Jane Street, right?
Yep, that's right.
What was that experience like?
It was really nice. I think I had a great time there. They're very good to me. I guess I was in college at MIT, sort of didn't know what to do with my life, and I had some friends who had interned at Jane Street, so decided I'd try it out, and I liked it, so I went back full time after I graduated. It was a really nice environment, and I learned a lot there. There was, obviously at the beginning, a lot of just sort of learning the ropes, talking to other people. Learning how they thought about trading, and then slowly, expanding the amount of trading that I was doing, starting off with just, a pretty simple case, and then, eventually growing into, more and more products that I was, first helping out with, and then in charge of trading. But even the longer I was there, there's still a lot of communication with the other traders. It wasn't like I was sort of siloed off with my section of the universe or anything like that. It's a very collaborative and communicative environment.
And what products were you trading there? I take it wasn't anything crypto related?
No, it was not. It was international ETFs. So I was trading US listed ETFs that were sort of composed of non-US equities.
What does that mean? Say that again, sorry?
Yeah. So I guess, you can kind of sort of start at the beginning, which is what is an ETF? So, an ETF, an exchange traded fund, it's basically a mutual fund that also trades on an exchange like a stock itself. And so, if you buy a share of an ETF, what you're doing is you're buying a share of a company that has just bought shares of a lot of other companies. So, sort of the most standard ETF is called SPY. It's the S&P 500 ETF. And what it does is it just owns a little bit of each of the top 500 companies in America by market cap. And so if you buy, 100 shares of SPY, you're buying, a little bit of Apple, a little bit of Google, a little bit of Exxon, et cetera. So that's what an ETF is. And ETFs have sort of two different properties. The first is that, well, you can trade them on the market like a stock themselves. So if you want to buy a little bit of everything, you could buy 500 different stocks, or you could just buy some shares of SPY, and you're sort of synthetically getting exposure to the top 500 companies. And it also has a primary market mechanism called creations and redemptions, where basically you can actually just go to the SPY company and say, hey, I'd like to deliver the 500 stocks, and they'll give you back some SPY, or you could give them your SPY and they'll give you back the stocks that it owned. So that's what an ETF is. I was trading U.S. listed ETFs, so ETFs that traded on the New York Stock Exchange, but where the companies that they owned, rather than being Apple and Exxon, they owned a Taiwanese semiconductor company, or Toyota, or Barclays. So they were U.S. listed funds that traded on exchange, but that owned foreign stocks themselves.
Okay, I'm with you. Interesting. And how long were you there for?
I was there for about 3 years.
Okay, and whereabouts? That was in the US somewhere?
Yep, that was in New York. So I was working on Wall Street there in their flagship office.
Okay, and so when did Alameda come about? And I am pronouncing that right, yeah?
Yep, Alameda. So Alameda came about in late 2017. I left Jane Street, and I liked it a lot there, and don't have any gripes at all. But I don't know. I guess felt like there were a lot of things I wanted to try doing in the world, and so I left, and shortly thereafter started exploring crypto, and it looked kind of crazy. You look at U.S. stock markets, and you're used to saying, "Oh, this thing's like maybe trading at the wrong price by 0.1%. Like, that's pretty weird." And then you get to crypto, and everything's multiplied by 50. It's like, oh, this thing, it's within 1%. And so it's just like wildly more volatile and dislocated than sort of U.S. stock markets were. And it seemed like, one of two things were true. Either all this data was fake and nothing was going on here. It's just like, this arbitrage is just some mirage, or it was an extremely exciting opportunity. And sort of started diving into it, and it quickly became clear that, about half the data was fake. But the other half was real. And in fact, there were some very exciting opportunities there. And in particular, there's a lot of customer demand for crypto, and just not a lot of liquidity being provided to it. And that was, dislocating a lot of the coins on a lot of the platforms and causing a lot of sort of arbitrage opportunities.
So up until this point, you hadn't really had any exposure to crypto?
That's right. I think I could have maybe explained roughly what a Bitcoin was, and that's about it.
Man, that's pretty crazy. That's a pretty bold move on your part to leave Jane Street and then sort of decide that, hey, I'm going to start a crypto trading firm.
Yeah, and it's definitely sort of a pretty, taking a leap of faith there, and a pretty exploratory move. I don't know. It seemed exciting. It seemed like, man, this could be really awesome. This could just be an unbelievably good opportunity, or there could just be nothing there. And if there's nothing there, that's okay. I've wasted a few months of my life, but I gave it a shot. And on the other hand, maybe this is like just a spectacular opportunity. And so it seemed like, even though I was pretty uncertain, it seemed like just the risk reward trade-off was pretty good.
Exactly, yeah. I mean, it kind of seemed as though you were almost looking for a new challenge.
Yeah.
So who did you start Alameda with? Like, how did you get together the team?
Yeah, so I guess I had a college friend who was bored as hell at Google as a software developer, who I sort of worked on some projects with and lived with back at MIT. And so I called him up, and he flew over to our fledgling 3-bedroom apartment / office. And started writing the code. And then I had, basically friends of mine from, various parts of my life, and then eventually friends of, the friends of mine that we'd hired. And we sort of just grew out organically like that.
Okay. And did any of these other people who you brought on, what was their kind of knowledge of this market like?
Basically, no one had any crypto knowledge. I mean, there were, where they come from, basically, software developers from Google and Facebook, and then quantitative traders from Wall Street who had never touched crypto before. And then some friends of mine on the operational side as well. But none of us had traded crypto before this.
Okay, fair enough. Now, a lot of people who are going to hear this podcast, the audience of Chat with Traders, obviously some of them are very active in crypto, but a lot of them aren't. And those who aren't are not going to be familiar with Alameda Research. So, just in a nutshell, before we kind of get into the nitty gritty, how would you describe Alameda? Like, what type of firm are you?
Yeah, so we're a quantitative cryptocurrency trading firm. We basically do, a combination of arbitrage-based trading, sort of quantitative signals and modeling, liquidity providing, and OTC trading across basically all of the major cryptocurrencies and cryptocurrency exchanges. And so, sort of the most basic thing you can imagine us doing is, well, on Coinbase, someone's willing to buy a Bitcoin for, $13,000, and on Bitstamp, someone's selling it for $12,900. So, we go to Bitstamp, we buy the Bitcoin, we send it to Coinbase, we sell it, and we've made $100. And, that's sort of the simplest arbitrage you can have in crypto. And 2 years ago, there's just a lot of that. There's a lot of really simple, large arbitrages. Over the course of the last 2 years, things have become a lot more competitive, a lot more efficient. And the trades that we're doing are more complex now. And so you can imagine, trades that involve multiple different exchanges at once, multiple different products all against each other, derivatives as well, and trying to understand the relationship between a future and the underlying. You can think about the various fiat currencies that are involved in crypto. And, you might think, oh, well, I can price Bitcoin against Japanese yen. You just multiply Bitcoin, Japanese dollar by, the FX exchange rate. But in crypto, nothing's what it seems. And a lot of these fiat currencies are only really sort of fiat currencies. And you look at, the Kimchi premium, which is the, Korean Bitcoins trading at, as high as a 50% premium to the rest of the world. How can that happen? Well, the reason is, it was only sort of against Korean won. It was against this thing called Korean won, but you couldn't actually take it out of the cryptocurrency exchange and buy dollars with it and get those out of the country like you might have wanted to. And, the Korean won is itself sort of a restricted currency. And then you can look at, a lot of stable coins, which they're sort of US dollars, but sort of not. And maybe it's not free to turn them into US dollars. And so, there's a lot of things in crypto where you can kind of see arbitrage as a significant piece of how you think about them, but it's not just a Bitcoin or just a dollar. It's something a little bit more complicated and nuanced than that. And, over time, our trading has started to expand into more and more nuanced trades as sort of the most obvious ones have gone away.
Okay. So just kind of reading between the lines and going off some of the comments you've made there, it sounds like when you first viewed the crypto market, you saw that there were a lot of arbitrage opportunities to be had there. What were some of the greatest difficulties or, the challenges that you came across, maybe some unexpected issues once you actually started to dig a little deeper and you started to really get into things?
Yeah, it's super interesting because, you look at these, whatever, Coinbase versus Bitstamp arbitrage, and you're like, look, I don't need to know machine learning to do this. Literally, I'm just buying a Bitcoin for $12,900 and selling it for $13,000, and I just made $100. And so you can ask, well, how can that be? If it's that easy and anyone can see it, why is it still there? And the reason is, well, a lot of the reason is sort of the infrastructure. There's a lot of things you take for granted when you're trading U.S. equities. If you buy a share of Apple on the New York Stock Exchange and you sell it on NASDAQ at a higher price, you just made money and you're done. You've successfully completed your trade. You buy a Bitcoin on Bitstamp and you sell it on Coinbase. Well, okay, you actually didn't have Bitcoin on Coinbase. You had one on Bitstamp. So how are you selling on Coinbase? Well, I guess first you got to send the Bitcoin from Bitstamp to Coinbase. What if you can't withdraw from Bitstamp? What if you can only get $100 a day out of the exchange? And you start running into things like withdrawal limits, where, on a lot of exchanges, it's actually very difficult to do a large trade because you'll just get your money stuck. They'll severely rate limit how quickly you can withdraw any of your funds from the exchange. And so that can make it quite difficult to do one of these. What else happens? Well, as I said, let's say that, there's a Bitcoin trading against some stable coin somewhere. So a stable coin, it's a token that theoretically represents a dollar. But the key there is that theoretically, what makes it a dollar? Well, the only thing that would really make it a dollar is if you could just hand someone the token and get back a dollar. And you could hand someone $1 and get back the token. But for a lot of stable coins, the way that you actually create these stable coins, maybe it's expensive. Maybe you have to pay 1% in order to create them. Maybe you have to pay 3% to redeem, or maybe you can't redeem. Maybe they just don't allow it. And now you're like, I don't know, like I can buy a Bitcoin for $12,900 and then I can sell it for 13,000 stable coins. Is that good? Is that an arbitrage? Well, it really depends on what you're going to do with those stable coins. Do you have a way to turn those into dollars? Do you have the right account on the right platform to do it? Are you going to run into limits? Even if you can do it, they're going to send a wire transfer to your bank. Will your bank shut your account down? It turns out that if you go to Bank of America and you're like, hey, we're a bunch of 20-year-olds, get this cryptocurrency trading startup. I'd like to send like lots of wire transfers to a lot of international businesses. And yes, this is Bitcoin trading, to be clear. They're going to be like, no, you're like the worst client that we've like. There's just no way, right? Like, imagine the anti-money laundering, know your customer risk for them there. They're like, so we can't track anything you're doing, right? Like, not only can we not track it, it's not even happening on US platforms. And so now you're like, well, okay, I thought I had this arbitrage, but now my bank account got shut down because I tried to do the arbitrage. And you kind of keep layering things like this on top of each other. And what you realize is that really the devil's in the details here. And that even a simple looking arbitrage can become quite complex operationally. And what you have to do is you have to have great accounts on the exchanges. You have to understand exactly what you can and can't do, how much you can get in and out. You have to understand the time that it takes to move a coin around the blockchain. You have to have a bank account that's willing to work with you and work with the platforms that you need to use. You have to have the capital to do these trades. You have to figure out how are you hedging any positions that you're putting up there in a realm where you can't short sell on most venues. And you have to take into account, risk associated with, hacks in crypto. And these things, they just keep piling on and on and on. And in the end, what you realize is actually there's just an enormous operational endeavor involved in really understanding all of the different platforms and products in crypto. And that a lot of the trades that look really easy, they're not really there. I mean, they're there, but you don't make money doing them because you didn't realize you're paying a percent of fees somewhere in this chain.
Is that part of the reason why you've set up shop in Hong Kong as opposed to the US?
It's a good question. And we're a global firm. We attempt to be active on all of the major platforms, trading on 30 plus platforms, trading $1 billion a day and trading a bunch of different coins. And in order to be able to do that, you have to be able to access from a lot of different jurisdictions, right? You need to be able to access the US exchanges, the Chinese exchanges, the Japanese exchanges, Korean exchanges, the Caribbean exchanges, European exchanges. And all of a sudden it's like, well, some countries just say, yeah, whatever, anyone can trade on this. But others are like, no, you need a real setup here. And so one thing that we had to put a lot of work into was developing, kind of a global corporate structure where we have entities in a lot of different jurisdictions. We have bank accounts in a lot of different countries. We have employees in different countries. And sort of over time, our business just became more and more global. And it became clear that we needed serious operations in a lot of different places. So that was one thing that was happening. And then the other thing is that over time, we've become increasingly client-facing. At the beginning, we were just a proprietary trading firm. We never talked to anyone from the outside. But we now have an OTC desk where customers can come and trade against us 24/7. We also recently launched a derivatives exchange called FTX in crypto. And for both of those, customer relations matter. And at this point, where is most of crypto happening? It's not in the States, it's in Asia. And so it also kind of became clear that, if we really wanted to have relationships with our customers, the place to be was, well, at least somewhere in Asia. And then why Hong Kong? Well, and to be clear, we do have operations in multiple places in Asia. But, we thought about a bunch of different things here, including what's centrally located, where is the bulk of crypto happening, what's the relationship of the country like to the important jurisdictions in crypto, and how easy is it for foreigners to get to set up shop there, and sort of all of those combined together when we're kind of trying to decide where we should be expanding and centering ourselves.
Yeah. Now that certainly seems like an enormous effort to be able to trade on. I think you said it was either 30 or 35, of the top exchanges.
That's about the number. Yeah. It's taken an enormous amount of work. On the operational side, getting these, entities set up and these banking accounts, but also just the dev side. Like, you have to connect to 30 different APIs. And, maybe many of these APIs are total shit. Like, these are not good APIs. These are APIs that just like don't have something. It's like, they just like don't tell you your open orders. And you're like, all right, well, how am I going to trade if I don't know my open orders? Or they won't give you a history of your fills. And you're like, oh God, like, what's going on here? And
what's my real position?
We have to find, exactly, right? Like, and, you have to find ways to get data that you trust. And that's a non-trivial engineering task when you don't really always trust the source of data to give you what you kind of think they should be.
Yeah. So I guess the natural question would be, why was it important for you to be active on so many exchanges? Like, what advantage was that to you?
Right. So the basic answer is that there are two ways to think about, what exchange you would choose. One, if you think of yourself as a liquidity taker, is my goal is I want to get long Bitcoins. I just want to buy a bunch of Bitcoins, right? And that's what you're saying. Then first of all, it doesn't matter that much where you buy them. But to the extent it does, you just have to find the one or two exchanges where you can find the best liquidity, where you can buy everything you need without having much impact, without paying large fees, and that it'll interface nicely with your systems. Another version of it, though, is like, I'm a liquidity provider, and my sort of role in crypto is to be on the other side of those trades, and to take advantage of arbitrage opportunities that arise because of customer demand. And so a lot of how we think about our trading is not like, we're just going to buy a lot of Ripple today. What we're thinking about is like, where do we see imbalances in supply and demand? Where do we see a ton of customers trying to buy some asset and not enough liquidity? So the price is running up there, maybe more than it's running up in other places. So it creates an arbitrage opportunity, but only if you're able to sell where the customers are actually buying, and similarly buy where the customers are selling. And so because of that, as a liquidity provider, it's important for us to be able to be out there wherever there are customers. And there's a lot of customers in crypto, and they're not very centralized. As you might expect, a pretty decentralized space. And that applies to the jurisdictional and sort of exchange ecosystem as well. And you have, a lot of this is cultural. You have, Chinese users on Chinese exchanges. You have American users on US exchanges, Koreans on Korean exchanges. Some of this is legal or regulatory. Some of this is where people get banking hooked up to their exchanges. And some of this is which products people demand and which exchanges have those. But because of this, you have a lot of isolated pockets of trading on different venues. And we want to be there to provide liquidity on all of those to the customers on each one.
How come you were interested in being a liquidity provider? Because you can trade arbitrage opportunities without necessarily being a liquidity provider. Like, those are kind of two separate things, right?
So I actually think that they're pretty interrelated. And, sometimes people use liquidity provider to refer like very specifically to someone who has a market making agreement where they'll have like a certain number of orders out at all times or something like that. But I think there's a more generalized version of liquidity providing, which just means being there wherever liquidity is demanded, being there to provide to customers wherever customers come. And if you think about what are you doing when you do an arbitrage, you're buying low and selling high. Well, why is it higher in one place than the other? If you're buying on Bitstamp and selling on Coinbase, why is there a higher price on Coinbase than Bitstamp? Well, there are a lot of possible reasons, but actually probably what's going on is some combination of, there are customers who are excited to buy on Coinbase, or there are customers who are excited to sell on Bitstamp. And actually providing liquidity to those customers is often exactly the same thing as doing that arbitrage. Both of those are another way of saying, you're selling to the customers bidding up Bitcoins on Coinbase and buying from the customers selling their Bitcoins on Bitstamp. And by providing liquidity to those, two sort of imbalanced supply and demand venues, you are actually completing the arbitrage. And most arbitrage arises because of something like this. Some place where there is an imbalance in liquidity demanded between two different coins or venues or platforms or derivatives or something like that, and you're kind of providing, sell side to the buyers and buy side to the sellers, and probably the buyers are driving up the price, the sellers are driving down the price, and so you probably have done an arbitrage when you did that.
Okay, so I guess when I think of a liquidity provider, like the first thing I think is they've got, bids stacked on one side and offers stacked on the other side, providing liquidity.
Yeah, and we do a fair bit of that as well. But again, I think these things are actually somewhat related. Like, let's say we've got a lot of bids stacked on one side and offers on the other. And now a customer comes in and lifts one of our offers. Well, that offer probably was above what we thought a Bitcoin was worth, which means that probably we can go buy Bitcoin somewhere else at a slightly lower price, or at least that's our hope. And if so, we've just done an arbitrage where one leg of it was the liquidity providing. And so I think that, if you're providing liquidity successfully, you're probably doing arbitrage at the same time. And the flip side of this is, and this is a little bit trippy, but I think it's basically true. People always think about the liquidity provider and the arbitrager as the one who's making, and the customer is the one who's taking. But imagine that, instead of offering a Bitcoin at $13,005, I offer a Bitcoin at $13,006. Then a customer places a bid at $13,005 and I sell to their bid. Is that really that different than if I just had that Bitcoin offered at $13,005 in the first place? Like, it's sort of the same result, but we flipped who's making and who's taking. And now you can get rid of the 13,006 offer if you want, and it's still sort of the same. And what you end up seeing is that, like, there's actually a really thin line between making and taking when it comes to providing liquidity. And you could have had a lot of offers out for them to lift, for customers to lift, or you could wait for them to place their bids, then hit their bids at the same price your offers would have been at. And sort of both of those are providing liquidity to the customers. And similarly, both of those are, probably you think you can do some sort of arbitrage with them. And so I think that, while it is generally the case that liquidity providers are the maker and customers are the taker, that needn't be true. There are places, and in fact, there are a lot of places in traditional finance where for various marketing reasons, that's not true. And the customers are the makers and the liquidity providers are the takers. And it's actually quite similar of a dynamic.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I think what might be interesting is if we could maybe go through, as a liquidity provider, as how you trade, how you would react to maybe certain scenarios.
Yeah, absolutely.
I guess like this video I mentioned earlier, where there was a huge sell wall on a particular exchange. I mean, what are you doing in that situation? I know someone can just go watch the video for a much deeper explanation, but obviously there's large sell walls or buy walls, vice versa. It doesn't really matter. But when you see something like that, how are you reacting?
Yeah. So, the context here is someone sold about $100 million of Bitcoins on Binance the other day. And they did it by just placing a giant offer for, $100 million. And so, how do we react to something like that? Well, I would say a bunch of things go through our, sort of think about a bunch of things at once. One thing is, who's providing to this customer? And that's sort of the liquidity providing side of this. Someone just tried to sell $100 million and they probably can't just place an offer and immediately get lifted at the current market price. I would not be excited to take on a $100 million position at the current price and then have to figure out how to get out of that. So what's probably happening is they're driving down the price. Whether that's happening because, and there are a lot of ways you can imagine that happening. They just keep lowering their offer until someone lifts it, or they just send one giant offer at a very low price at the beginning. But either way, there's sort of this auction almost where they're auctioning off, 10,000 Bitcoins to whoever's willing to bid the most for them and seeing how low they have to go to get those buyers. And so the first thing that I think about is, well, should we be one of the buyers? Are they offering these Bitcoins at a price where we actually just want to buy them from the customer? And if not, what price do we want to buy them at? At what price are we yeah, we'll just buy those? And in this particular case, actually, they placed their offer low enough eventually that we did definitely want to buy them. And again, you kind of see this relationship between taking and fretting there, where there weren't enough bids out to fill this order. So instead, they just placed it as an offer and waited for the liquidity providers to come in and take their very low offer for the Bitcoins. So the first thing is, do we want to buy this? And once we decide yes, the second thing is, well, can we? And the thing in crypto is that you don't have one balance sheet. You have a separate capital pool on every exchange. I can't spend my dollars on Coinbase to buy a Bitcoin on Binance. That doesn't work. So the next thing we need to do is get a bunch of capital over to Binance to buy this with. And in particular, the seller was selling it for what's called Tether, USDT, which is a US dollar-based stablecoin. So the next thing we need to do is get a lot of Tether over there to buy these Bitcoins. And that's sort of a somewhat crypto-specific phenomenon of completely fractured capital bases. And it really matters where physically your assets are, and you need to get them in the right place in order to trade. So the next thing we're thinking about is, all right, we want to buy this. Now physically we have to do that. So we have to ship a lot of Tether over there. And well, first we got to find a lot of Tether. So, one of our trains of thought was all of the different pieces that we needed to put in place in order to be able to buy these Bitcoins. The flip side of this is that, we want to hedge this trade. We want to find some ways that we're not very exposed to Bitcoin price. And so on the other side, we're thinking, well, okay, we know we're buying a lot of Bitcoins right now. Where are we going to sell? And so at the same time, we were thinking about, okay, here's all the platforms we're on. Here's sort of our thought of all these products. Given all that, putting it all together, what's the best thing we can do given both sizing and pricing and things like that. And so simultaneously, we were trying to decide, what are we going to sell? Where are we going to sell it? And what do we need to do to be able to sell the size that we need there? And so those were sort of the first two things that we were thinking about there. And then maybe the third thing that we were thinking about is, what does this mean for markets? What's this going to do to Bitcoin? What's going to happen when they place this order? What's going to happen when it goes away? Is Bitcoin going to go up, going to go down? And that's a complicated question. You're never going to be sure, but sometimes you can kind of get an instinct on that.
Okay, so I guess maybe a silly question, but why did you want to buy this? I think you said the offer moved down maybe a couple prices to an area where you became interested. But why were you interested in taking this offer?
Right. So I think there are two ways to think about this. The first is we just looked at what price it was at, and it was trading 2% lower than all other Bitcoins in the world. So there was just an arbitrage. And buying this and selling Bitcoin somewhere else, you just made 2% on that trade. So that's sort of the most straightforward answer to your question, is we waited until it was offered lower than other Bitcoins and we could do an arbitrage. And then we did that arbitrage. Maybe another way to approach this, though, is that it's not surprising that happened. Because this guy really wants to sell all those Bitcoins. He's going to have to keep moving those Bitcoins down and down and down until we want to buy, or until people like us want to buy. And so it's sort of not surprising that, like, ultimately his offer settled in a place where it did make sense for us to buy, because, you know, that was the thing that stopped it from going even lower, was that we bought it up. And in fact, it wasn't just us. It was us and many people like us, all sort of racing to get their tether over to Binance to be able to buy these Bitcoins. And so we kept moving it down until it hit the price where we would be able to make money buying it and selling somewhere else.
Right. So once you've just taken all these Bitcoin, you have a pretty heavy long position. What's your next step from there? Like, I guess you're immediately looking to see where you can sell these and offload them on different exchanges?
So we do it actually at the same time. And so it's not so much that we buy all the Bitcoins and then we're like, all right, what are we going to do with these Bitcoins? It's as we're lifting this offer, we're simultaneously selling in other places. And that also gets back to the capital thing. Obviously, they're not the same Bitcoins, right? They can't be, because those Bitcoins we're just buying on Binance against it takes half an hour to get them anywhere else, just as blockchain time. So we have to have other Bitcoins in other places that we can sell, or some derivative product or something, some way to be able to hedge this trade. And as we're buying these Bitcoins, we're selling in other places.
Okay, so you're buying into this large sell wall offer on Binance. Meanwhile, you're stacked on the offer on a bunch of other exchanges around the world.
Exactly.
Okay.
Yeah. And now, again, you can kind of see why it's an advantage to be on a lot of different exchanges. Like, all of a sudden, we want to source a lot of sell side, we want to be selling a lot. And we want to be able to source as much liquidity for that as possible to be able to hedge this trade.
Okay. So what about, just another example I'll throw your way, what about in a fast-moving market? Like, as a liquidity provider, as a market maker, my basic understanding of it is that it's easier to make a market where, there's a lot of sort of two-way flow. If it's just a fast-moving market in one direction, a lot of the flow is sort of one-directional. Obviously, buyers are very aggressive. How are you reacting in an example like that? Like, are you just pulling your offers out of the way, or what do you do there?
Yeah, it's a good question. And I think I would flip this on its head a little bit. And what I'd say is that, sort of by default, it's easier. Whereas in a very fast-moving market, because it's harder, because it's more chaotic, that also means that there are a lot of opportunities if you can fight through the chaos that other people haven't managed to get to. And so I think the way we think about it is not that it's a better environment when things are calm. We think it's better when things are chaotic for us. And the reason is we think that we're, one of our relative strengths is understanding chaotic environments, is understanding, well, how do we price these assets when everything's moving? It's not like a Bitcoin's just been trading at $8,000 for the last month, and we buy at 7,900 and we sell at 8,100. Like, no, things just move 5% the last minute, but actually not everything moved 5%. Like, everything's moved a different amount, and there's dislocations everywhere, and liquidity is really thin. And now, given all that craziness, we have to decide what we're going to do. And so a lot of what we've been doing over time is building up systems that use a variety of quantitative models combined with sort of human intuitions and real-time adjustments to attempt to still be able to do good trades and understand what's really going on, what things are really worth, while everything is flying around and prices are skyrocketing or crashing, and there's huge one-way flow. And that's where you see larger opportunities and larger arbitrages, exactly because they're harder and they're only going to be there for a few seconds, and only if you can realize exactly what this thing is worth, even when you're getting a lot of conflicting signals. Right.
Okay. So what would you say is like the biggest risk as a liquidity provider in the crypto market? Like, what's the biggest risk to you guys?
Yeah. And I think that, like, risk can mean two different things. And we sort of split it up very much between these two. One sort of risk is like the risk that we just don't make much money. And, to that extent, what are the risks? Well, obviously, more competition is one of them. Us just doing a mediocre job, I think, is probably the biggest. It's, this is a really complicated, messy environment. And you can only do these trades if you get a lot of things right. And if we just kind of half-ass it, and we're like, yeah, I don't know, it'd be nice to have this bank account, but it's a lot of work. Let's not bother. Now, all of a sudden, some great trade comes up, but you can only do it if you can send money to that bank account you didn't bother getting, because it seemed like a lot of work. And now you're not making money. So I think that's sort of maybe our biggest risk in terms of just like, why would we stop making money? The answer is we just are kind of lazy, just don't do a good job and we'll stop making money. Like, it's not like we just have this machine we can turn on and it's going to print money forever. Like, we need to keep innovating, keep working hard, keep refining our systems, keep refining our internal intuitions about what's going on, and keep getting better every day in order to keep up and to keep growing. So that's one way to think about it. Then the other way to think about it is like, what's the biggest risk for us losing a lot of money? And on that, well, there are a few big ones. I think exchange hacks are obviously one of these. And so, we have to be really mindful of like, where are we putting our assets? Do we really want to have, $20 million sitting on Quadriga? Like, yeah, that probably wouldn't have gone so well. So, being smart about how much you're putting where, managing your risk. And then there's another one of like, do you just do something totally crazy? Do you decide, yeah, let's get long $200 million of Bitcoin. Hopefully it'll go up. Well, it's fine if you got $10 billion and a mandate to take risk. But if you don't and Bitcoin crashes, you just lost a lot of money. And so I think we kind of think about this, the large risks as like, one of them is like somehow like, an exchange loses our assets. And the other is like, we just put on positions that we have no business putting on that are way too risky, and we get unlucky and lose to them.
Something I did want to ask you, and I think this ties in here, is, you said the word systems, and it just made me think of this. To what extent are your trading decisions discretionary versus model driven? I know there's obviously certain instances like what we spoke about before where there's a large sill wall on an exchange and you're talking about sort of taking that. But just on a more regular sort of normal trading environment?
The answer is somewhere in between. And in particular, almost all of our volume is done by automated systems, but they're automated systems with heavy amounts of real-time manual input. And so we have, quantitative traders 24/7 monitoring all of our trades and adjusting parameters. And rather than thinking about our automated systems as some sort of like brilliant black box that can outsmart all humans or anything like that, we think of them as like a really dumb human that can do 100,000 things at once, almost. And, the reason that we need automated systems is we want to be trading on, thousands of markets, and we want to do it quickly. And we want to be computing a lot of things on the fly, and those are not things humans are good at. But fundamentally, our systems are just doing what our traders tell them to do, just like really quickly. And so, in the end, if they're doing a trade, probably it's because we decided that that trade would have been good. And if there's a trade they don't do, it's not because our systems suck. It's probably because we didn't realize that was a good trade to do, and so didn't tell them to do it, or didn't give them the tools to figure out that that would be good. And so, a lot of our trading is somewhere in between. It's done by automated systems, but it's very human legible, and it's done sort of with real-time monitoring and input and feedback from humans.
What might be an example of parameters that you adjust kind of on the fly?
Yeah, so I'll give you just some of the most common ones. And one of these is, what should our positions be? We stay pretty hedged. We're not putting on huge positions, but we do put on small positions. And, we have traders actively thinking about should we be, long $50,000 of Ripple right now? Should we be, short $100,000 of ETH? And we have parameters to sort of instruct our systems to do that. So that's one set of parameters that we look at a lot. Another set is how much edge should we be looking for? Should our systems just do a trade if they think it's really marginally good? Or should they wait till it looks extremely good before doing anything? And how should that depend on the coin, the environment, the exchange, the price currency, what we've been doing recently, a whole host of factors. And we're tweaking those frequently. There are parameters about, if we're providing, how large do you want to provide? Do you want to show 100 Bitcoins at this price, 50, 1,000, 2? That's sort of another parameter that we'll be sort of pretty actively thinking about. And then maybe one last thing that I'll just mention is capital management. Again, because exchanges don't share capital bases, you need to be physically moving your stuff around to trade. And so we have pretty heavy, human input on where all of our assets should be, so that we're kind of set up to do the trades we want to do.
Okay. That's really interesting, actually. That's I appreciate you sharing that insight.
Of course.
Now, you did mention hedging there, and you've mentioned it a couple times, and I guess I've kind of glossed over it to this point. And I should ask you about it because it's such a big part of what you do.
Yeah.
Just talk to me a little bit about how you are hedging and why there's the need to hedge, how you actually hedge. Yeah.
So the first thing that I'll say is that, we think of hedging as accomplishing two different goals. One goal is risk, and the other goal is expected value. And maybe I'll start with the second one. Sometimes when you hedge, it's not because you're worried about the risk. It's because you think you have a bad position, right? Maybe you buy a bunch of Bitcoins. You're like, I think Bitcoin's about to go down. I'm long. That's bad. And you probably want to hedge that position. You probably want to sell somewhere. The second is, I got 100 Bitcoins. I don't really know if it's going to go up or down. I don't have a particular opinion on that. So I could easily win or lose to this position. But I just don't want that variance. I don't want that volatility in my profit. I want to be clean. And the first you always want to be thinking about. And so one thing we often think about is like, do we have toxic positions on? Like, do we have positions on that we're actually going to probably lose to if we don't hedge? And the second is more a question of what's our risk tolerance. If we buy $10 of Bitcoin, we don't need to hedge that. We're fine taking that, 50-cent P&L swing. But, if we put on $1 billion position, there's a 50% chance we're just out of business tomorrow. And even though in the other 50% we make a lot of money, we don't want to take that trade because we don't want to go out of business. And so, the second way that we think about hedging is like, if we risk too much, we might endanger our firm's ability to continue operating and to continue trading. And that would be really bad. And so for that style, what we're thinking about is like, well, what scales that matter at? Like, how big of a position can we put on before we have to start thinking seriously about this? And probably you want to not get to the point where you have to think seriously about it. Probably you want to have put on a substantially smaller position than that. And in order to do that, even if we don't think Bitcoin's particularly going to go down, the more Bitcoins we buy, we got to start selling. Then moving on to how do we do it? Well, we have a bunch of different ways. There are a lot of platforms in crypto where you can do margin trading of one sort or another. And we basically take advantage of all of those and try and figure out dynamically, sort of at each point in time, what's the best hedge for our position? What hedge do we think we're going to make the most money, or at least lose the least money putting on?
Okay, so just one of the scenarios that you mentioned there, I'll pick up on that. So you said that you were long, let's say 100 Bitcoin, and you didn't really have a view on where it was going, but you felt as though it wasn't a position that you wanted to lose a lot of money on.
Right.
So you might hedge that position. So how are you actually hedging that? Like, what are you doing to hedge that?
Right. So obviously the most obvious thing you could do is send those Bitcoins to Coinbase and then sell them for dollars. But that's kind of a shit way of doing it. Among other things, you have to wait an hour before you can hedge. And maybe you'll lose in that hour. And also, it's going to tie up all of your capital, and you're going to be limited to the liquidity on one exchange, and a bunch of other things. And so, what are ways you can hedge? Well, that is one way. You can, if you're long, you can find Bitcoins you have lying around and sell them on some exchange for dollars. If you're short, you can find dollars you have lying around and go send them to exchanges and buy Bitcoins with them. But there are other things you can do too. So maybe you could go trade futures somewhere. You could find, on BitMEX, there are Bitcoin futures products. CME has Bitcoin futures. OKX will have Bitcoin futures. There's a bunch of these lying around. And you could do a margin trade on one of those where you post some collateral. And if you're long, you could sell some Bitcoin futures. And now you've got some Bitcoins and you have a short Bitcoin future position to hedge it. And those aren't exactly the same thing, but they're pretty related. And eventually those Bitcoin futures are going to expire to the price of a Bitcoin. And so, you're no longer really exposed to Bitcoin going up or down. And so, we look at a lot of futures platforms. We also look at places where you can margin trade spot. So, a bunch of Chinese exchanges have ways that you can put on a leveraged position just on Bitcoin versus Tether. Kraken has some Bitcoin US dollar margin trading on it. Bitfinex has margin trading. And, sort of throwing together all of these different venues, there are a bunch of places that you can, get longer or shorter cryptocurrency exposure without needing to send those same physical Bitcoins over there to trade.
Right. Just continuing with this same scenario, where you're long 100 Bitcoin, you're not really sure where it's going to go, you don't have a view on it. You also have the view that you don't want to lose much money on the position. Why would you choose to hedge that position rather than just sell back into the market?
So we would consider that a way of hedging. If you're long 100 Bitcoins, you just bought 100 Bitcoins, one way to hedge it is to sell those out again. And that would work. And so then the question is, why would we do something else instead of that? Why don't we just sell our Bitcoins? And the reason is, well, let's go back to this Binance example, right? Someone just sold, 10,000 Bitcoins on Binance. We bought a bunch of them. Well, the reason we bought them is that the Binance Bitcoins were really cheap. They're trading at a low price because of the seller. And if we wanted to get out of this risk by selling those Bitcoins, you'd be selling them back at that same low price. And it would defeat the whole point of having done the trade. And, in general, when you're sort of doing arbitrage, probably if you just sell out in the same market you bought in, you're going to lose all of your arbitrage gains. And what you want to do is instead sell on the higher markets, sell on the places that didn't have this big seller driving down the price.
One of the things I do find very interesting about you and what you've been able to achieve with Alameda Research is the fact that you've only been going for 2 years. And it seems like you've just really grown at an exponential rate. I mean, what do you think is I don't want to use the word secret, but what's been the driving force behind that?
Yeah, I think the answer is sort of working hard. I mean, it's sort of a lame answer, but I think that there's a lot of truth in it, the working hard and hiring good people. I don't think that we have this, one weird trick to grow your company in 2 years or anything like that. I think it really is just like, we threw together a lot of really impressive employees. I'm like extremely happy with our team. And we've just really been plugging away. Like we've been, and it's not just we've been working long hours, but we've also just been trying to hold ourselves to a really high standard and not feel like, we made a successful business. That's what we're going for. We're done now. Instead, just like, but it could be bigger. It could be better. And however much we've done, there's always way more to do. And every single day we build on that. We build more tools. We build more models. We throw out models that don't make sense anymore. We think of more trades. We get onboarded to more venues. We get more, bank accounts and entities. We hire more people. We build more relationships in the space. And we just keep going at this. And we make sure not to get complacent, not to stop. And we try and be self-critical about it. We don't congratulate ourselves for everything we do. We fuck up sometimes. And when we do, we try and figure out, what did we do? Like, why didn't this work? Maybe we just got unlucky, in which case that's fine. That happens. Shit happens. But maybe it wasn't luck. Maybe we kind of could have realized this would have happened. And then we should figure out, well, what underlying mistake are we making? Like, what's sort of the thing that we should be changing about, our models or behavior or understanding or anything like that, that would, have caused us to not do this. And so I think that that's one big piece of it. And, kind of pursuant to that, we've kept going forward. And, we've built out a pretty big trading operation. We're, something like 5% of global crypto volume at this point. But, we also haven't stopped at that. And so, we ventured into the OTC space. We built an electronic OTC trading platform where users can get 24/7 automated quotes. And then a few months ago, we released FTX, which is a cryptocurrency derivatives exchange. And kind of similar to the Alameda trading operation, we're seeing this as a product we really want to make the best, make it as good as we can. And we're not just trying to release a thing that is a derivatives exchange. We're trying to release the best derivatives exchange. And, we're going to keep iterating, keep releasing new features as quickly as we can, keep taking feedback, understanding what we can change about it so that it is the platform that people want to use, that fixes all of the issues that other platforms have in this space. And, I expect us to be releasing more and more things going forward. And, for Alameda to keep discovering, more and more ways to trading crypto. And maybe one last thing I'll say about this is, I think one piece of this about not sort of getting complacent is that, I sort of originally came into this space with the goal of donating, with the goal of, making what money I could and then giving it away. And the interesting thing about that is that, if you're just a human buying cars or something, there's a lot of very, very compelling evidence that beyond a certain point, money doesn't really make you any happier. You've got a perfectly comfortable life. The next $1 million isn't going to do very much for you. Maybe your car gets a little faster. But when you look at the scale of the world's problems, it's massive, right? There's, thousands of people dying of preventable causes every day. And, all of a sudden, you're not talking about how much could you spend to make one person's life better. You're talking about billions of people's lives better. And just the scale of funds that you can deploy to that are massive. And, it's like you're talking about like $1 billion to really fix some really large problem in the world, like, people dying of malaria or, and because of that, like, it sort of didn't make any sense to stop scaling Alameda once we, become reasonably big. It kind of has felt pretty naturally like there's always more that we could be doing. And we sort of have the mandate to always do, push forward as far as we can.
Yeah, that's a really respectable answer, man. I think that's
Thank you.
That's very good of you. Now, just to take things out here, I guess I should ask you if you have, a longer term view on the crypto market, like a macro view on, where you see things moving forward over the next couple of years. I don't normally like to ask these sort of questions, but I feel like in the crypto market,
you sort
why
of have
not?
to.
Yeah, and I'm sure you've got some opinions on that.
Yep. So I do have some opinions, although they might not be as exciting or extreme as could be. I think basically that it could go either way. Sort of the boring answer. Like, I think that you could imagine a world where crypto is just fucking huge, and you could imagine a world where it just kind of whimpers away. I think both those are possible. And I think one question is, well, what are the odds each happen? And they actually both seem pretty plausible to me. Like, it's not just possible, like really could happen. Like, you could imagine crypto really taking off. It's already kind of gotten an enormous share of the world's attention. And you could also imagine the world just saying, like, yeah, this is kind of stupid. Like, why do we think so much about this? It's kind of electric money. The US dollar is totally fine. We're just going to stick with that. And what's going to determine that, I think, well, it's a lot of things, many of them probably pretty chaotic and random. But one thing is, can the space get its shit together? There's a lot of pretty broken things in crypto right now when you scratch beneath the surface. Exchanges that have lost hundreds of millions of dollars to poor risk controls. You have the inability to actually move your money around between the platforms, which is ironic for an asset whose whole point is you can move it around easily. You've obviously had a lot of scams, and beyond that, you've had a lot of ICOs where, sort of the approach was, let's create a coin, let's sell it, then let's maybe create a company, or maybe not. We'll sort of see about that last one. All of these things, you say, like, why isn't the institutional money flowing in? But you go to Goldman, you're like, all right, so here's the deal, guys. 6 chains lost a few $100 million last year. It's going to charge you, probably millions a year in fees. And you can only get $1 million a day out of it. And 3/4 of the products listed there have no company associated with them and somehow have $100 million market caps. And I don't think Goldman's going to be like, yeah, that's our bread and butter. They're going to be like, what the fuck? No, we're not going to touch that. And so, I think that like a lot of what will determine this is, can this space really, I don't know if professionalize is quite the right word, because you also sort of want to retain its, innovation and all the things that made it kind of take the world by storm, but can it maybe do that, but cut out the bad shit? And I think that's going to be one big piece. And I'm going to just say one other thing on this, which is, what's a Bitcoin worth? Sort of an interesting question. I don't know. I certainly don't know. But when I've tried to think about this, I've gone through thought experiments like, well, I don't know, which should be bigger? Which should have a higher market cap, like Bitcoin or like, the currency of Estonia or like Poland? Or how about like Australia or Taiwan or the United States or the euro? Like, where would you slot Bitcoin into that? And so you can kind of guess like, well, I don't know, like about which country do I think about has, about as much power in the world as crypto? Another approach might be, what are the odds that Bitcoin is the new euro, that like in 20 years, like, 20% of the world's using it as their primary currency? You can try and think about like, how does it compare to gold? Like which, if it's gold's to become a store of value, like gold seems like kind of the standard there. And those are sort of 3 different ways to estimate the value of a Bitcoin. And, they're not easy, but I think you can actually get like some plausible ranges from that. And I don't know, whenever I try and do it, I get ranges somewhere between like 1,000 and 100,000. And that's obviously like a huge range for the price of a Bitcoin. But it's worth noting we're at 10,000 right now, which is sort of, the geometric mean of those, which makes me feel like, I don't know, the current price is pretty plausible. It doesn't seem obviously too high or too low. And that, it doesn't seem to like, obviously it's going to go up from here or obviously it's going to go down from here. It seems like, yeah, either could happen depending on whether it does move closer towards achieving that goal of becoming the euro or gold or something like that, or whether the world just kind of decides, well, this is kind of a cesspool. Like, let's just forget we ever did that.
I think that's a really interesting answer, given how invested in the space you are. And I don't mean invested as in like you're 100% long Bitcoin or any crypto product,
But obviously my businesses are extremely long the space, even if they're not literally long, because the bigger the space is, the more business there is for us to do.
Yeah. So I think it's interesting that you have a very neutral view on the macro outlook of the crypto market.
Yeah. And I think one thing I will say is, I do think the upside is maybe higher than the downside. Like Bitcoin, I don't think it's going below 0. That'd be a little bit difficult, but it could more than double. And I think like, people often use this argument for stocks and it's kind of stupid, but for Bitcoin, I think it's real. Like it couldn't, more than just double, it could 10x. And so I do think that there's a pretty plausible argument of like, well, kind of 50-50 on whether it goes up or down, but if it goes up, it could go up a lot. But I don't believe that extremely strongly. And, I don't feel like it's just like, obviously Bitcoin's going up.
Yeah. Yeah. Okay, man. Well, let's leave things there. Like I said, I have a ton of notes here, and there's a lot we didn't even get to, but maybe we should try and line up a part 2 at some point.
Absolutely.
Because I've really enjoyed this. It's been, I've found it really fascinating to get a bit of an insight to how you guys are running your business over there.
Thanks. I've enjoyed this too, and would be excited to go for round 2.
Yeah, cool, man. If someone wants to follow you or just get a bit more info, learn a bit more, you're on Twitter?
Yep, so you can find me on Twitter. I'm SBF_Alameda. You can find AlamidaResearch.com or Alameda Research at, Alameda-research.com. And you can find FTX, our derivatives exchange, at FTX.com.
Okay, and your OTC business, is that all through Alameda? That's not a separate sort of spin-off?
That's right. So actually you can do it through either Alameda Research or FTX. They both have the same platform on it. And both FTX.com and Alameda-research.com have links at the top to the OTC portal.
Okay, good one. I'll include those links in the show notes as per normal, and I'll also include a link to the video that you posted while you were live trading the other day.
Sounds good.
Because I think that's worthwhile, everyone checking out. So I'll put that link in there as well. Sam,
awesome.
Again, I really appreciate this. Thank you for taking an hour out of your evening to speak with me. It's appreciated.
Of course. Thanks for having me.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Once again,
Great
Nick,
stuff.
really appreciate it, man. We'll talk soon. Thanks a lot.
Okay, appreciate it. Thanks, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey ladies, hey gents, Aaron here, and thank you for tuning in to episode 179. I have a special guest on this episode, and that is Mike Komaransky. For many, I'm sure this will be the first time hearing about Komaransky, but those who know him already know him as a Bitcoin OG, and deservedly so, as he began accumulating the cryptocurrency around 2010. Though Mike has been a professional trader of fixed income derivatives since 2001, when he joined powerhouse trading firm DRW. Mike later became a partner at DRW, and in 2014, he launched its crypto trading business, Cumberland. Over the next few years, Mike and his team, including Bobby Cho, who's appeared on previous episodes, they grew Cumberland to become one of the world's largest cryptocurrency market makers. Then in 2017, Mike left the company to spend some time overseas. But he has returned, and he's again active in the market. His new firm is Grapefruit Trading. Over the course of our conversation, we chat about Mike's distinguished trading career, the strange ways that Mike has bought Bitcoin in the past when it was far less accessible, Cumberland's participation in the auction of seized Bitcoin from the Silk Road bust, Mike's disdain for technical analysis, which I'm sure some of you will get a kick out of this bit. And in between all of this, lots more. The last thing I would like to point out is that Mike is an investor or a partner in CoinFlex, who have been a sponsor recently. However, this interview is entirely separate from my sponsorship agreement with CoinFlex, and actually, I first made an attempt to get Mike on the podcast almost 2 years ago. And now, here he is. Mike Komaransky, folks, episode 179. Well, I wanted to say it was cool that you had a chance to check out the interview I did with Sam from Alameda. I mean, what were your thoughts on that?
Sam's a very bright person. He came from Jane Street, so that tells you something. Their FTX and Alameda, they've gone from zero to like a very significant player in cryptocurrency trading in the course of 2 years. That's really impressive. And the only way you can do that is just by working hard. That's what he said when you asked him, what's your secret? And it was really just hard work. So congrats to them. I think they'll be around for a while. It was a great podcast, and we're in a similar trading category. So like many of the questions that you've asked him, I would respond similarly. Like how do you differentiate between market taking and market making? What do you do when you have a big position? How do you get out of your trades? How do you approach the market? He's answered a lot of that, so I don't have to.
Yeah. Were there some parts, they've been going close to 2 years. You've been around in this space for a lot longer. Were there some parts, like, could you relate to where they were on some level? Like thinking about your early days starting Cumberland?
Yeah, I think it's the opportunities, when you looked at them, you'd say there's no reason this should exist. Like this arbitrage, it's so simple. And if it were really there, then someone else would have done it. But it's just not the case. And immediately you say, okay, well, take everything you've learned from traditional trading and just multiply the spreads, the margins by 100, maybe even 1,000. I was in fixed income from 2001 until 2017, with a little bit of overlap of crypto in between. And when you're trading fixed income derivatives, you're dealing with quarters of basis points, not even quarters of basis points. You're dealing in 30 seconds of basis points, the thinnest of margins. And then you're introduced to Bitcoin, and you've got one exchange trading 6% higher than another one, which was the case in 2013. You say, this is just amazing. So you kind of drop everything and focus on crypto. That was sort of the genesis of Cumberland.
Yeah, well, that's one of the things which I think is so interesting about you, because I've had crypto traders on the podcast in the past, and I've been like, yeah, I used to trade stocks, or I used to trade futures, and now I trade crypto. Whereas you know, that's still true in your case. You used to trade futures and fixed income derivatives, but you actually started as a pit trader, if I'm not mistaken.
Yeah, I think more technically, I was a pit clerk. So in 2001, I was graduating in the University of Chicago, and someone from DRW came to do an interview on campus. I had trouble getting investment banking interviews because maybe I wasn't strong enough, or I wasn't prepared enough, or even driven enough. But here comes these trading companies. They come after the investment banks, and they sit you down for half an hour, and they just pummel you with like 2-digit by 2-digit multiplication questions. I'm like, really? That's why I got a math degree, just to multiply. So you sit there and you do your best you can. And it also helped that they were looking someone from athletics too. So I was a soccer player, and the reason they do that, once you go into the pits inside the CME or the CBOT, like a physical presence actually matters. Where like some of the best traders weren't the brightest people, but they could physically push you, not push you around with like big trades. They could actually just elbow you out of the way in order to get onto a trade. So I think that was like the ideal candidate in 2001 was somebody who could multiply and push people. The lifestyle or the typical job candidate has changed since then, obviously. So I multiplied, I got a job, and then I went down to the CME, and I was a clerk behind Don Wilson in 2001, and I learned a lot in that first year. Stood behind him, learned how we traded options, learned a bit about the futures market, and my career kind of took off from there.
What sort of trader was Don at that time? Obviously, Don's a pretty big name. Well, that's a bit of an understatement, isn't it? But, I mean, was he a significant trader at that point in time, or was he still sort of coming up as well?
No, at that time, he'd already made a name for himself. The company DRW was probably 40 people, I'd say. And the type of trader he was a risk taker, but at the same time, he had a very strong grasp of the theoretical value of the things he was trading. That's, it's sort of a broad statement.
Yeah.
But you can trade with bigger size if you're leaning on mathematics or finance or some reason to take the risks that you're taking. That's one thing that I carried with me through my time at DRW.
Would you be able to just elaborate on that a little bit? Are you talking about like when you have maybe a mathematical edge or a quantitative edge? Or, yeah, can you just expand on that a little bit?
Sure. Mathematical edge is something that you can gain in the markets, especially derivatives markets, where you apply some sort of financial model to a problem, or something not from finance, like you apply like the Black-Scholes equation. Kind of it didn't develop directly from finance, but it was applicable to finance. And then with time, you can develop a theoretical price for the thing that you're trading, and if you can buy lower than that price and sell above that price, and do it many times, eventually you'll come out ahead. The important thing to know is, with efficient markets, your ability to capture that edge will decrease rapidly over time. So one important thing that Sam talked about in the Alameda interview was that you have to constantly innovate. If you have an edge in the marketplace, you should not expect to hold it for a long time. And while you have the edge over the marketplace, you should exploit it as much as possible. So, 2001, you've got some people who know how to price a call option. You know how to price perhaps a butterfly better than your competitor. You know that they're going to catch up with that mathematical formulation. So while you can price calls better than your neighbor, you should trade for large size and get as much volume as possible.
Mm. How long?
And if you can't describe your edge in the marketplace with a single sentence or maybe 2 sentences, then it's probably not an edge you have. You're trading, maybe making money because you're lucky, or maybe you're not trading enough to realize whether you're a good trader or a bad trader. But you should be able to identify the edge that you have in 2 sentences.
Do you feel as though the way that you're trading today, which we'll get to later on in this conversation, but you could sum that up in 2 sentences easy enough?
For any individual trade where I expect to make money, yes, that's true. Unfortunately, I might not be able to tell you those 2 sentences because I want to capture the edge while it's still there.
How long did you stick around for on the floor? Like, how long was it until you moved on to screens?
It was about a year and a half. I was down in the pit, and then the futures market slowly started moving over to electronic. And it was after my first year that I started doing the night shift. And as stupid as it sounds, there was the CME futures, which had maybe 1% of the volume trading electronically. They were priced differently than a completely fungible contract in Singapore at the Cymex exchange. So I would sit there on the phone with someone in the Singapore exchange and just do arbitrage with the screen at the CME. That was like, it's silly. It doesn't exist anymore. It couldn't exist anymore. Everything's electronic. Everything's bots. Everything's computers. But there was a time when you could talk to a person and just make money.
Man, that's a pretty crazy time. Wow. So let's fast forward a few years. I think it was probably around about 2010 when you began to get involved, or at least interested, in Bitcoin. So let me ask you, what did it mean to be involved in Bitcoin in 2010, and how'd you get interested? Like, how'd you even hear about this magic internet money?
Yeah, so 2010, I came across, I was reading a website called Marginal Revolution. Still exists today. I bet some of your listeners frequent that website. It's just a collection, a well-curated collection of interesting takes on economics. And it has a very libertarian or Austrian view on certain subjects. So Marginal Revolution one day just posted a link to something that said Bitcoin P2P currency for the internet or something like that. And I clicked on that, and it brought you to the white paper, the Bitcoin white paper. And I'm like, whoa, this is something special. This has potential. I didn't understand it completely, but from what I understood, I thought we should devote a lot of time and perhaps money to this. So Bitcoin 2010, there were maybe, 200 people on the Bitcoin forum, bitcointalk.org. I joined, and at the time, there was maybe one message posted a day by one of the members. That's it. So there wasn't a lot of reading up to do about it. Sort of all the information was there in the white paper, a little bit on the forum, and then a small IRC community popped up. Like a old school chat room where people talked about it. And the community back then of the 200 and quickly increasing to 1,000, 2,000 a day people, they were mostly libertarians or anarchists. Maybe a couple computer developers, but they were all like, this is going to end the state. Money is going to change forever. I get excited about that thing too. I was one of them. The community has changed since then. I think there's a lot of speculators and traders and who knows. But Bitcoin's for everyone now. But at the time, it was for these really fringe anarchists. What that also meant in 2010 is that there was a tremendous opportunity to invest in Bitcoin, because the other people that know about Bitcoin, they didn't have a lot of money in 2010. These are anarchists living in their parents' basement, and their mining rigs are in their garages. So in 2010, it was like, okay, how do I accumulate Bitcoin as quickly as possible? And then basically that became an obsession. Or at first it was a hobby, then it was an obsession, and then 2014, we fast forward, it became a career.
How did you begin accumulating Bitcoin back then? Like, how were you even buying it? I presume it was much more difficult than it is today.
Yeah, the first way you could get it was by mining it, but that just didn't come quickly enough. You could mine on a laptop, which is what I did, and you get 50 coins a day, maybe 50 coins every other day. And if you know Bitcoin, you know that mining gets more and more difficult as people get interested in it. So mining just wasn't the right option. So the best way to do it back in 2010, 2011 was, the best way for me at least, was to meet people in the street and hand them envelopes full of cash and have them give you Bitcoins.
What do you mean give you Bitcoins? What would they give you in return for your envelope of cash?
Imagine you're a programmer in London who knows how Bitcoin works, and you know how to mine it better than the average person. You set out and you start mining thousands of Bitcoins a day. Well, you might not necessarily be interested in Bitcoin, but you know that you can sell it on the street to somebody like me, and you can pay your rent. So you go online and you look for the Bitcoin marketplace. This is before Bitcoin exchanges existed. That's why a lot of people forget that in 2010, there was really no exchange. So the only way to do it is go online, find somebody, and say, I agree to meet you at Starbucks, and you give me £1,000, and I will give you, 4,000 Bitcoins.
But how did they give them to you?
So I hand them the envelope. They count the money there on the spot, and then they take their laptop or their phone, probably laptop at the time, and they'd send to my address.
Okay.
An address that I gave them ahead of time. So then all I have to do is check the blockchain that the Bitcoins have arrived. Maybe you wait 10 minutes or 20 minutes to make sure that you're not getting screwed on the Bitcoin transaction, and then you walk away.
So is that something you really did? So you were mining some Bitcoin, and then you were meeting people with envelopes of cash to get more.
Mm-hmm. Yeah, that really happened. And the reason I stopped doing that was, it had nothing to do with the price, because, if you believe Bitcoin is going to, if there's a chance of it replacing world currency, which I did believe, then you wouldn't stop buying just because it's gone from 1 cent to $100, right? You have the dreams that it's going to go up to where it is today, and even beyond, to the point where it replaces. So what stopped me was I was afraid of my bank. I was afraid of the government. Bitcoin was so new, and it had such a bad reputation that I don't know what's going to happen. I thought, there's no way that I can keep all this quiet from from the government. And what happens in 10 years if they come after you with like guns at your door? Give me all your Bitcoins. We know about you. So the first thing that happened was, I'm getting envelopes full of cash in London from my bank and giving them to people. But that activity at the bank, like where you withdraw £1,000 or £3,000 at a time, that raises red flags for them. So they ask, this is a serious conversation I had with the teller. They're like, oh, well, we've noticed that you've taken out many cash deposits, and we have to ask you what this is for. And I was ready for this question. And I told them that I played a lot of poker, like live poker games at tables. And the problem was that I'd never deposited dollars or pounds. So they must have assumed I was perhaps the worst poker player in London. Like, sir, you have a problem. You might need to stop.
Just losing money hand over fist.
Yeah, and then when they started asking me too often, I knew it was maybe time to stop those types of transactions.
Well, this is something I did want to ask you. Like, what opinions did you have about Bitcoin at this time? You said when you first came across the white paper that it seemed like it was something really special. So what opinions did you have about it at the time?
I'm very skeptical of government, especially even before Bitcoin. I always thought that them being able to print more money was a very special power the government had, and it's susceptible to abuse. Maybe not in the United States, maybe not in the UK, but at least in other countries, I could see people abusing that. So I always thought that the monopoly on money issuance and money creation, I thought that was an unfair tactic that the government had. And inflation truly, for me at the time and now, is a theft. So I was always looking for a replacement, like an electronic money. I dabbled in, do you know the game Second Life?
I know the name.
It was a silly game popular in the mid 2000s. It wasn't really a game. It was just sort of an alternate universe where you could walk around and, I don't know, talk to other people, make your avatar wear a funny t-shirt, do a dance.
Okay.
You can even buy like property. So in that game, there were things called Linden dollars. It was an in-game currency. And the only way you could get Linden dollars was, number one, when you signed up for the game, they'd give you, I don't know, let's say $10 worth of these Linden dollars. Or you could, inside the game, you could sell funny looking t-shirts and people would give you Linden dollars for it. So I'm thinking, wow, okay, that's cool. In-game currency, it only exists on the internet. That sounds good, but the problem is who creates these? And the answer was, it was Linden Labs, the creator of the game. Like, okay, well, let's see what Linden Labs is. And Linden Labs was run by a libertarian guy. And he's like, I am in charge of the issuance, and I won't create anymore after X number of years. Something along those lines, where you put in your faith in Linden Labs not to create more Linden dollars. And I thought that was interesting, especially if it was libertarian. But man, wouldn't it be great if there was like an online currency that wasn't issued by like a central Linden Labs type of person, even if they promise that they're going to do it, or they're not going to issue more. But it was controlled by no one or by mathematics. So that's like the precursor for me to Bitcoin. That was maybe in the year 2006, 2007. And my investment in Linden dollars failed. I guess maybe they printed more money in the end. They fell back on their word. I don't know why Linden dollars fell apart, but they just never took off. So, when the white paper came across my path, I'm like, okay, this is what I was trying for. And I sort of had a head start on the rest of the world.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
You mentioned something a little earlier, which I found quite interesting, and you said you were one of the first few hundred members or users on the Bitcoin message board. Was that early enough when Satoshi, the creator of Bitcoin, when he was active on the message boards? Because I thought...
Yeah, he was responsible for some of the more interesting posts on the forum. And he was active when I was around. I think maybe we had 2 forum boards where he was active and I was active at the same time, but we never exchanged emails or messages.
Okay.
If you're listening, Satoshi, send me an email or something. And it's not, by the way, it's not your countryman, Craig Wright.
I don't even know anything about that story. Let's not even go there.
Not talk about it anymore.
Yeah.
Waste of time.
I know nothing on the subject.
Neither does he.
Okay. Now, you started Cumberland. So you were at DRW from, was it 2001? So from 2001, and then Cumberland only came about in 2014. And you were the driving force behind that, right? That was your idea to start, to start this crypto trading desk.
Yeah. So from 2010 to 2014, I was the annoying guy in the office who couldn't stop talking about Bitcoin. You might know 1 or 2 of them yourselves. Wherever I went, I'm like, oh, it's going to change the world. You guys got to get some of this. And, no matter what the conversation started off as, it could have been like a Chelsea-Tottenham match. It would end up me talking about Bitcoin. And I was just not a popular person for a long time, but at least they knew I was interested in it. Those people that did listen to me, by the way, I think they did pretty well. But I mean, I understand I was annoying, and I probably spent too much time talking about it. So in 2014, I think the landscape of trading started changing for crypto. Several exchanges were getting more volume, more traction. There were even some derivatives popping up, which is sort of like the best of both worlds for me. I was a derivatives trader, and I love Bitcoin. So it was an exciting time for me. I think there's not many people who trade something that they truly love. Like if you're a corn options trader, it's not because you love corn so much that you just want to spend your time trading corn options. Or maybe you are. Some weird people out there. But for me, like Bitcoin is something I truly loved, and there was a trading opportunity. So that was very cool. And I could have continued that in my own personal trading, but it started taking up more and more time, and the opportunities themselves required more and more capital. So I approached Don at the time, and I suggested that we should open up a real trading desk for Cumberland, and he was on board because he was starting to get excited by crypto too. And I think some of the other partners at DRW were skeptical. Remember, at the time, 2014, we're coming off the back of like Mt. Gox collapsing and losing hundreds of millions of people's Bitcoins. Also, I think Silk Road was making news. Like Bitcoin just had a really bad name. It wasn't just a bad idea. It was a bad idea, and there were crooks and money launderers and drug users involved. It was just not the right place for any institution to pick up and say, yeah, let's do this. But DRW, to their massive credit, they said, okay, let's give Mike and my partner at the time, or my trading partner at the time, Eric Saraniecki, who we call Wally. So let's give him a chance and see what we can do. And at the time, they're like, okay, we'll do it under one condition, that you can't use DRW's name, or we can't use our banks. Just do your thing and don't drag us into this crazy world if you can avoid it. And that was a bit frustrating. If you want to start an OTC desk, which I think is what we wanted to do. If you want to start an OTC desk, you want to be very vocal in public and say, hey, you can trust us. There's not many people you can trust in crypto, but you can trust us because we're DRW. And then they take away your ability to do that by saying, no, you can't use our name. Is basically like starting from scratch. But the advantage is we had the capital to use. So that was the genesis of Cumberland. It was called Cumberland Mining at the time because Cumberland, the very first project was going